Hello everybody and welcome back. In this video we are going to talk about Fortinet. They just reported earnings and in pre-market the stock is down 12%. So in this video I want to talk about the earnings report because I did all the work for you. I have a lot of comments to make about this earnings report. We will analyze the numbers together. And also, I want to share with you some work I just finished. My own Google Sheet with adjustments, with some charts, so you really understand everything that is happening with Fortinet and the third quarter of 2025. What are the reasons why the stock is down? Is this a good buying opportunity? In this video, you will have all your answers. This is the only video you need to see, to watch, to understand what is happening with this company and whether you should buy it, you should double down, or you should sell. What should you do with your portfolio right now? Okay, and I also listened to the earnings call and I added some comments here, some quotes from the earnings call, so you don't miss any information. And spoiler alert, there are some things that Wall Street has missed. Wall Street analysts have only discussed short-term things, and in this video we'll talk about the long-term. Okay, the long-term big picture from Fortinet. Fortinet is a company in the cybersecurity industry, right? And now with the rise of AI, you will need more cybersecurity budget. You will have more cybersecurity demand in the future. So this is what we are going to do. Report and then Google Sheet, play around with some numbers, add some commentaries, and you will know why I am buying more. Because as soon as the market opens today, I will sell some of my Amazon shares to buy Fortinet. And this is exactly what I said in this video here that I released a couple of days ago, 8 days ago. This is what I had to say about the situation and the earnings season. Let me put the microphone here so you can hear nicely. And then we'll start. And if this is getting boring, maybe the stock will go down. And actually, for this company, I want the stock to go up immensely. For Fortinet, I want the stock to go down so I can buy more. For Amazon, I want the stock to go as up as possible. Because I want to sell the position, so it will be... Yep, exactly. So, lucky me. Let me put this again. Lucky me, the prophecy happened, and I was very lucky with the two guesses because Amazon reported earnings and the stock was up more than 10%, and they announced a deal with OpenAI and the stock was up again. And Fortinet reported earnings and the stock is down. So wonderful. And this is not the first time I am buying Fortinet. I was a shareholder in 2020. The stock had a triple and I sold at the top. And now the stock is down again, so I am buying more. And I bought this summer at a price of $75. And now, in pre-market, the stock is again $75. But now we have more visibility. Now we have more optimism. Now you have more buybacks. Now you have more margins. So actually, I am very happy to buy Fortinet today. I can't hide my smile today because I'm very lucky with the timing. The exact prophecy happened. Okay, I think we can start, and we will start with the report. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. Okay, investing in quality companies, and I believe Fortinet is a quality compounder, quality company available at a fair price. Okay, this is how I have made 25% per year. And I'm on track this year, 2025, to generate 25% per year. I'm outperforming the market so far this year. Very happy with the results, and I plan to continue. So let's start with the report. This video will be long. This video will be complete. Take a cup of tea, take a cup of coffee, take some cookies with you, anything, and enjoy the show. So first of all, the revenue grew 14% for Fortinet. This is decent, but this is disappointing because expectations for this cybersecurity industry are very high. If you compare Fortinet to CrowdStrike or Palo Alto Networks, they are all increasing their guidance. So CrowdStrike, Palo Alto Networks, Zscaler are very bullish and they plan to grow at more than 20% per year. So here you are, Fortinet, only growing 14%. This is a sector hungry for hyper growth, more than 20%. So this is quite disappointing. Here is the first reason why the stock is down. Okay, first one. Second line here, you have a product revenue that grew 18%. This is pretty good. From a slowdown in the second quarter, now the product revenue is reaccelerating. I put this in green because this is good news. And I put this in red because this is bad news. Billings grew 14%. Second reason why the stock is down today. The billings, so the backlog, you can say, what has been received for future revenue in the future, is only growing by 14%. This is not that great. This has always been fluctuating, and now we are on the low side, low end, not that sexy. In a sector that is hungry for more, only growing 14% is not that great. Another point that is very good is that operating margins are at all-time highs. Fortinet is the only cybersecurity company that is focused on efficiency and margins. I already mentioned CrowdStrike and Parallel to Networks and Zscaler. For example, these three companies are not profitable. Yes, they grow more than 20% per year, but they don't focus on efficiency and profitability. They focus on acquisitions and they focus on growth and market share. Fortinet is having another mindset. They want to grow at a reasonable level, 15% per year, but they want to focus on margins, on buybacks, on earnings per share. And as a long-term investor, I'm much more comfortable investing in these kind of businesses. This is why I'm buying Fortinet and not the other ones. Also, if you look at the valuation, Fortinet is cheaper. It's cheaper because it's growing less, right? Okay, now you have a comment from the CEO of Fortinet. We are pleased with the excellent third quarter results driven by our leading innovation and customer-first culture, resulting in broad-based demand for our solutions across organizations of all sizes. They talk about the technological advancements they have, and now you have a few highlights how Fortinet is embracing AI. First of all, they mentioned the FortiSASE solution that is having billings increasing by over 100% year over year. So the more AI segments they have, AI services, more tech, is seeing a lot of demand. And the FortiSASE segment is growing 100% year on year, doubling. I put this in green because this is good news. And I have a small comment here. My estimation is this segment is very small. It's only $150 million annualized. So still small and irrelevant. So yes, this is bullish. Yes, you are seeing some traction, some demand for your AI enabling services. Okay, but this is still small. Okay, the revenue for the quarter is roughly $2 billion. So on an annual basis, Fortinet is doing what, $7 billion in revenue, something like this. So this is very small. So now this is the bull case. This is irrelevant for this year. For next year, this segment is irrelevant. But what if it doubles again? Because you have a lot of demand in the future. Maybe in 3 or 4 years, it will be relevant. Very high margins. Okay, so I just wanted to have a few comments on this. This is not really important, but it is still a small green flag. Also, we launched the secure AI data center solution. What is funny is a few hours before this earnings report, Fortinet issued a press release talking about their data center investments for AI-related services. And this is what they are talking about here on their earnings report. They want to invest in building their own data center solutions. And this will cause more capex. You will have more, you will need more building of capex, more facilities, more data centers projects, and this will only continue in the future, which means if you increase your capex, you reduce your free cash flow. And Wall Street is not expecting this. This is also what I said in my previous videos on my channel. Wall Street is not expecting a ramp up in capex. And let me spoil the fun a little bit. The capex for this quarter increased by 140% year on year. The capex more than doubled. Yes, this is still a small amount, but the capex is doubling. This is big. What if it continues to double again next year and double after this? So be careful about the efficiency and the capex expansion in the future. But yeah, I put this in red because that's a potential yellow flag for this business. A third reason why the stock is down. As I told you, Wall Street is not expecting a ramp up in capex. Now they are ramping up the capex, and the ramp up in capex is decreasing the free cash flow. This is not bullish, okay? Third reason why the stock is down. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. What is good for us is at the same time you have this big capex expansion, the margins are at all-time highs. So yeah, the company is investing, but they are still efficient. Also, they say achieved rapid adoption of AI add-on solutions, blah, blah, blah. They are integrating AI. If you know the cybersecurity industry, you know that now with AI, you will have much more cyber attacks. It's much easier now to have cyber attacks, much more advanced ransomwares. So in the future, it's very easy to guess where this industry will go. In the next 5 years, 10 years, you will need more cyber defense. You will have an increased budget for cyber defense. So a good way to invest in AI, either you can invest in the hyperscalers, Google, Amazon, etc. Or you can invest in, HVAC companies, the build out, the mechanical, how to build the data centers, a lot of manpower, a lot of electrical, mechanical stuff. Or you can also invest in cybersecurity companies. A good way to invest in AI is investing in cybersecurity. Okay? So Fortinet is my investment in AI, if you want. And yes, they are embracing AI. They are seeing a lot of demand, and they will see much more demand in the future. Also, during this quarter, they reduced their guidance for Q4. The management is being conservative. A fourth reason why the stock is down today. The Q4 guidance came in a bit below expectations. The revenue was a little bit below the consensus, and the billings guidance was a little bit below the consensus. Okay? They expect an effective tax rate of 18%, and for the fiscal year, they expect the non-GAAP operating margins in the range of 35%. They expect margins to go a little bit down from here. So the guidance is not great. The guidance is not that good. The guidance is lower than what Wall Street expected. People don't like this. So this is still a good earnings report, right? You are growing profitably, 14% per year, but Wall Street expected better. This is why the stock is down 12%. Let me continue. I want to say a few things about the balance sheet, because now that Fortinet is enjoying more data center expansions, they want to invest in themselves. In the past, they did not have a lot of capex because they relied on Google Cloud. But now they want to have their own in-house data centers. So you have this new line, long-term investments. They are investing more capex. Also, second thing I want to highlight is the long-term debt of this company has to be paid off. So the long-term debt here was in the past $1 billion. Now it's $500 million. And this $500 million remaining went into the current portion of long-term debt, which means next year, Fortinet will have to use the free cash flow to repay the debt. So you can expect less buybacks in 2026. Or maybe they will just roll over the debt and take more debt. Fortinet doesn't have a debt problem. I'm on Guru Focus right now. If you scroll down, you can see the debt level. On an annual basis, Fortinet never had a debt problem. This is a company that is quite conservative, quite safe. And you have more and more cash. The debt has been minimal. On a quarterly basis, what was the data last quarter? You had $4 billion of cash, $1 billion of debt. So debt is not a problem. Just so you know, you will have to repay the debt next year, or you will have to reschedule the debt again. Okay. On the balance sheet also, you see the cash and cash equivalent that has decreased because they did the biggest buyback ever. This is pretty bullish actually. If you look at the amount of buybacks they've done this quarter. Here is no, this is not this one. Net issuance of debt. Am I crazy? This is the one. Log 12 months. Repurchase of shares. This is what we have quarterly. Okay. Look at this. This is the amount of buybacks they have spent. You can see that this quarter, that was just released today, they repurchased 1.8 billions of shares. This is their biggest buyback ever. I made a video about this a couple of days ago, saying they will do maybe more than $1.4 billion. $1.4 billion was announced, but maybe they did more than this. So yeah, they did $1.8 billion. Don't worry, later on my Google Sheet, we'll look at the average price, the amount of shares, what is the percentage of buyback, etc., etc. Just wanted to highlight that this is the biggest buyback ever for this company. This is why the cash is dropping. Okay, so that's it for the balance sheet. Nothing really important to say. About the income statement now. This is maybe the most important financial statement for this company because you have a few adjustments to make. But before we go deep into the Google Sheet and the adjustments, and before we go too deep and too technical, let me browse through the cash flow statement to show you the increase in capex, as you can see here by this red line, and also a buyback for the 9 months of $2 billion. Last year, 2024, they did 0 buybacks. Now, on a year-to-date date, $2 billion already. This is a big year for them. Okay, now that you know a few points for this company, let's go deep. Let me zoom in so you see better. Okay, fair enough. I created this Google Sheet, and in the C column, you have the latest quarter. In the D column, you have the quarter for last year, and you have the year-on-year growth rate. As we said at the beginning of this video, the product revenue went up 18%. Pretty good. The service revenue went up 12%, 13%. Not so good. You have a deceleration. Here, you have a comment. Check the differentiation, security subscription, and technical support. This is this. On Fiscal AI, what is great is you can go to financials, segments and KPIs, and you can check the growth rate, if you click on this toggle, of the product and the total service revenues. This is your growth rate mix. In blue, that's the growth rate for the services, what is only growing by 12% this quarter. As you can see, in the past, this was growing 30% per year. So extremely bullish, and now it is slowing down. And in red, you see much more cyclicality. The product revenue the growth rate was negative 1 year ago, and now it is up and trending up. Fun fact, in the second quarter of 2025, the growth rate in red was 12%, and the majority of the earnings call was the management team explaining that this is okay, this is fine, and Wall Street analysts kept asking the same questions. Will you grow more than 12%, or is this a good plateau growth rate? Well, they went from 12% growth to 18% growth. Pretty good. The new problem is this deceleration of the blue line. The total service revenue is only growing by 12%. This is not so good. And the management has something to say about this one. Okay, I added a few comments. The comments are mine, or if you have quotes, that's from the management team. For the product revenue, this is the highest growth rate since 2023. This is the most important for Fortinet. Fortinet is an old company that is not embracing cloud very well. You need the product revenue to grow. So this line, this growth rate of 18% is the most important part of this report actually. This is why it's very bullish. Now, management has added a few comments during the earnings call. We see our improved product revenue growth and customer expansions in 2025 as leading indicators for improving service revenue growth expected for the second half of 2026. In case you don't understand, let me explain. Fortinet has two segments, products and services. First of all, when you get a new customer, you sell your products, your hardware. And once a customer has a hardware, you implement a subscription behind this. So first of all, you have the revenue from the hardware for the products, and then you have the subscriptions, and then you have the services. So if you have an uptick in growth, if you have better growth, better revenue growth when it comes to hardware, in a few months, in a few quarters, you will have a lag, but the services revenue will grow. The service revenue will grow immensely. You have a correlation with the lag. So this is exactly what they're saying. Now the product revenue is ticking up again. You have better growth. So you can expect a lag and the service revenue to go up, but not now. You have a lag of 1 year, the second half of 2026. Next quote. I do believe the product revenue on average normal case will kind of around 10-15%. Will be kind of a low double-digit growth, which matched quite well for the last 16 years since we IPO'd. I feel, product revenue growth, I feel like it's kind of normal. This is a quote from the earnings call. And Tal way, okay, just to follow up, what we see is not a shortage of potential growth drivers and opportunity. In anything, the opportunity is so great that we have to prioritize where we drive growth. Okay, maybe I'm not being clear here. During the earnings call for this quarter, there was an analyst that asked, what about the guidance? Now you are growing 14% per year. Do you expect more? I mean, everybody is growing more than 14% per year. Why are you only growing at this rate? It's because you don't have opportunities right now, maybe. You don't see reinvestment opportunities. And the CEO said, we have too many potential growth drivers. So we have to work to prioritize where we drive growth. Do you believe the management team? Maybe yellow flag. I'm not here publishing this video, only highlighting the good, right? This is not the goal of this video. The goal is to also point out what is bad. So in the next quarters, you can check if they delivered, okay? So this is a medium answer, I would say. They see too many growth opportunities, but you're only growing 14% and you don't have a guidance for next year. I would not be very confident in what they are saying here. But I agree with the CEO. The product revenue is expected to grow 10-15% in the future. Okay, so that was for the product revenue. For the service revenue now, I have a few comments. Security subscription is still decelerating. Yes, I showed you these two lines, blue and red, but you can also break down the red line. The blue line. So you can put product revenue, security subscription, technical support. Instead of having a service line, you can have this, a breakdown. In blue, that's the security subscription revenue trending down. This is not good. In the past, this part of the service segment was growing 30% per year. Now it's only growing 12% per year. Not good. And in orange, you see technical support and other revenue. This line is plateauing. So this is fairly good. And if you summarize these two lines, you have the service lines. Okay. So the blue line is decelerating. You don't want to see this. You don't want to see the subscription run rate decelerating. And this is something I will have to monitor for the next quarters. So technical segments growth rate is stable. What they have to say is unified SASE. That's SASE. And SecOps now account for 26 and 11% of total billings, respectively, up a combined 3% points. Basically, what they have been saying on the call is the service parts are getting the service parts are getting more important. The AI-related services are getting more importance in our revenue. Last year, what was related to tech and AI was 34% of the total amount of billings. Now it's 37%. So as the year goes by, you have more importance when it comes to AI. As a reminder, in case you're not really familiar with Fortinet, this is a legacy company, hardware company, and 2 years ago, they embraced AI. 2 years ago, they started this new unified SASE SecOps project, and the growth rates have been immense. And in the past, this was not 30% of the billings. It was much lower. But as they are growing more than the overall company, the importance of these two segments is growing. Okay, now 37% of total billings. It will increase the overall margins. These are very high margin segments. Fortinet is gradually pivoting from firewall only to SASE plus AI plus OT hybrid model. Okay, if you combine these two segments, the product revenue and the service revenue, you have a growth rate of 14% for the revenue. At the same time, you have the billings of 14%. We've seen this during the earnings report. It's not great, but not bad. We want this to go up. Also, the remaining performance obligations are only up 10%. It is not good. Will growth decelerate again next year? Yeah, I can show you what I mean here. I've talked about the billings, about the backlog, and you can have this line on Fiscal AI. These two lines, total billings, remaining performance obligations. You can see that in the past, these two lines were at 30%. Now the billings went down, negative, and now we are at 14%. At the same time, your RPOs are going down, which is not good at all. So these two lines indicate maybe the business is decelerating. Maybe they don't see a lot of demand. So you can cross-read what the management team is saying. We have too many opportunities, too many growth drivers. So we have to prioritize where we invest our growth. And you can see the data. Things are decelerating. Will things improve again? Well, this is why you have a market. I think these two lines will go up again in the future because I believe in the management team and in the company. If you don't believe in this story, this is not a company for you. Okay? But what we can see right now is the business is decelerating. Still okay, right? You are growing 10-15% per year. Full margins. So it's still decent, but this company is not growing a lot. Okay. So total revenue has grown by 14% per year. At the same time, your cost of product revenue is up 32%. So they are growing the revenue by 18%, but the costs are up 32%. So they are investing massively to get more customers, I suppose. Same thing for the services. Services are up 12%, but the costs are up 18%, which means the total cost of revenue is up 26%. Okay? This is not so great. It shows a lot of investments in the business. Maybe they want to reinvest massively to be more, how can I put it, innovative to get more customers in the future. And because your costs are growing faster than your revenues, the margins are down. For the products, the gross margin for the products are down from 71% to 67% because of more investments. And for the services, the gross margins are down from 88% to 87%. Maybe now you start to understand where this company is going. You might be negative about the company. And because I've been following the company for a while, I can show you this chart. You have the gross margins. The gross margins for the products in red and the gross margins for the service segment in blue. Are you terrified by this chart? I am not terrified. So yes, you have a decrease in margins a little bit, but for the red line, you are at a very high level, right? Sustained plateau of more than 65% gross margins. Same thing for the blue line. Yes, we are down a little bit, but not so down, right? We are still at a very elevated level, okay? So something that Wall Street didn't like at all was the heavy investment here, the decrease in margins, but actually the margins are fine. The margins are still sky high. So now you start to understand what Wall Street thinks about this company and what I think about the company. Wall Street wants better growth. They want numbers to go up and to the right. What I see here is a company that is enjoying very nice margins and growing at a reasonable level. And the stock is down 12%. People don't like this report, but I think the report was pretty decent. Overall, because you have more costs than revenue, the gross profits are up 12%. So revenue is up 14%, gross profits up 12%. And the overall gross margins for this business are down, obviously, from 82% to 81%. Okay, let me continue with other lines if you go down the income statement. I hope that's clear because you have a lot of things happening for this report. The R&D line is up 8%. Fair enough, you have efficiency. The sales and marketing line is up 13%, in line with revenue. The general and administrative line is down. Maybe they fired some people. Maybe they had some legal expenses. Maybe something else. But this is down. And you had a tiny line that doesn't matter. The total operating expenses are low, but they are up 27%. The business is enjoying more costs now. If you do the calculation, you find an operating income that is up 16%. Despite the heavy investments, despite the deceleration in growth rate, focus on efficiency, you have an operating income that went up by 16%. The business is still fine. You are growing operations, your EBIT operating income by 16%. The EBIT CAGR, the EBIT compound annual growth rate, is higher to the revenue CAGR. The revenue is growing by 14%. Your EBIT is growing by 16%. Things are fine. Things are absolutely fine for this business, and the stock is down. So, because the EBIT is going up more than the revenue, obviously you have better margins. A small improvement in operating margins from 31.2% to 31.7%. You see how all the costs are working together? You are increasing massively your cost of goods sold, but at the same time, you are getting more efficient for your total operating expenses. And you are talking from a low base, which means the margins are going up. They are in a lucky position of being asset light. They can invest more and still be very efficient. Okay, so this is good and improving overall. And I have this chart to show you the difference between the EBIT and the gross profits. Now, as I told you, okay, now you can see. I hope you can see well. The blue line here, that's the operating profit growth rate. Now we are at 16%. And the red line here is the gross profit growth rate. You see, these two lines are not going hand in hand. You have a correlation, but the operating profit is much more volatile. And now these two lines just crossed. So we are in a position of efficiency where the blue line is superior to the red line. Okay, so the EBIT is growing more than the gross profit. Okay, let us continue because this report is quite dense with the interest income. So the amount of interest you generate based on your cash in your balance sheet, almost no change. Interest expense, almost no change. This is a minimal number. And here is this line, other income net. Nobody is talking about this line. Zero questions during the earnings call. Zero people on Twitter or on YouTube. Nobody is talking about this line, but it changes everything. Because last year, in 2024, you had a gain of $100 million. Now, you don't have this gain. So, you have a difference of $100 million. And this is the reason why the income before taxes is down 5%. You go from an operating income growth of 16% to a net income pre-tax of minus 5%. This is huge. If this line was flat, you would have a pre-tax profit of growth of 14%. So this is why the earnings per share is down. Let me explain what is happening so you don't have to do the work. This line, I have a few comments. You have a gain on bargain purchase that was $106 million during the third quarter of 2024 and is related to our acquisition of Lacework. And then you have $18 million that is the real data. So that's due to $13 million gain in marketable equity securities and $6 million decrease in foreign currency exchange losses. So the real number, if you have to adjust for this acquisition accounting change, the real number should be 18.8. Make the adjustment. The $106 million gain on bargain purchase is a one-time accounting gain from buying Lacework, it's an acquisition, for less than the fair value of its assets. It's not real operating profit, it's non-cash and should be excluded from core results. Because the goal of this exercise, the goal of this Google Sheet is to understand the real core operations of Fortinet. We want to dismiss what is fake, what is not working, the adjustments, the accounting changes. Lucky me, I have a master's degree in accounting, so I can do these adjustments. And I'm making this video because I've seen nobody do the work. I'm here to show you the way. So you have to adjust for this change. Because when a company pays more than the fair value of net assets, that excess becomes goodwill. Normally, when a company makes an acquisition, and the acquired company has what? $1 billion in assets. If you pay up a premium to buy a company, you pay $2 billion, you have an excess, right? And your difference, you put it in the goodwill. What if you have the reverse of goodwill? You pay less than the assets of the company. Accounting wise, how do you put it? Well, you do this. Here, Fortinet paid less than fair value. The difference becomes a bargain purchase gain, also called negative goodwill. So the real line here is not 118. The decrease in earnings is fake. And I'm seeing people on Twitter or media, press releases, talking about a decrease in profits, a decrease of 12% when it comes to net income. Yes, if you only look at the raw data, yes, but you have to adjust to really see if the core business is improving or not. So we'll make the adjustments later, but just so you know, the real number is 18. Okay? Let us continue. If you don't make the adjustment, you continue as it is, you have income before provision for income taxes and the gain from equity method investments, minus 5%. At the same time, here is your tax rate. The taxes improved by 48%. Let me repeat. The revenue is growing by 14% and the taxes are growing by 48%. Can you spot the difference here? You have a tax rate that went from 13% last year to 20% now. That's another adjustment you have to make because you have a massive tax rate increase this quarter. That is the biggest, how can I show you? This is the biggest tax increase we've had in a while. If you go to Fiscal AI, you can navigate through all the tabs. You can use my link, by the way, in the description. Now you have a Black Friday week, so it's 25% cheaper if you use my link in the description to use Fiscal AI. If you want to have access to all the charts, all the data in live, this is one of the best websites you can have. So here is what we have. This is your effective tax rate. As you can see here, the tax rate is up, and in September of 2024, the tax rate was 13%. You have a change in tax rate. What is the new tax rate? What is the real tax rate? Was it fake in the past and now that's the real one? Or is it fake right now? Will the tax rate decrease in the future? Plenty of questions, and you will never have a clear answer for this question. What I can show you is the guidance for this company, and they don't expect the tax rate to go up meaningfully. Okay, this is first of all what I can assure. So the tax rate will not go higher than this. Maybe it will stay at 20%. Maybe it will go down. But you see that the tax rate has a massive difference. Massive difference in tax rate from 13% to 20%. So if you have this change in accounting because last year you had a gain because of an acquisition, first adjustment. At the same time, you have a massive tax rate increase. Second adjustment. If you account for some gain losses from equity methods, we don't care. These are small numbers. Your net income is going down 12%. Down 12% because of these two adjustments that I have highlighted in red here. I noted here, this is not the first time the net income is decreasing. This is part of the company's track record. Here you go. You can see here a chart, a red chart. This is the growth rate in net income. You can see in 2021, the growth rate was 0, and then it decreased to 0 again, negative territory in 2023, and now it's back down to negative territory. Okay, fair enough. So net income officially is down. Add to this a little bit of buybacks, and you have an earnings per share that went down by 11%. Okay, now I want to show you the truth. I want to show you the truth because this earnings per share line has to be adjusted. What if you make the adjustment and instead of having 118, you put the real number, 18.8. If you only change this, the net income is now growing 7%. Now about the tax rate. If the tax rate, you change the tax rate and instead of having, the adjusted tax rate is now 15%. Okay, let's show 15%. How can I show you? This, no, I want 15%. Yep, could be roughly this. If you don't change your tax rate, because you really want to understand the core operations of the business, not the accounting changes. If you make these two adjustments, the other income and the tax rate, the pre-tax income is going up by 13%. The net income is going up by 14.5%. The company did their biggest buyback ever, so the earnings per share, the real earnings per share growth rate is 16%. That's a massive difference. And I've seen nobody talk about these two adjustments. So if you only look at the core operations of this business, you have an earnings per share growing 16%. This is really good. And the stock is down 12% today. Okay, now let me change these adjustments. Okay, we are back to an earnings per share loss minus 11%. I have some comments here about the buyback line. Okay, this is a quote from the earnings call. We repurchased 23 million shares of our common stock for an aggregate purchase price of $1.8 billion in the third quarter, which reduced our total share count by approximately 3%. In August, our board of directors approved a $1 billion increase in the authorized stock repurchase amount, and the remaining share buyback authorization is $800 million. So this summer, they announced a new buyback program of $1 billion, and they already started to use it, to use $200 million. So if you divide this by this, the average price of the buyback, I calculated it to be $78. So my guess is they did a lot of buybacks here, and they stopped here, around here. So as the stock price dropped below $80, they were aggressive repurchasers of their own shares. So the management team thinks they are cheap below $80. My strong guess, strong guess is in the next quarter, they will continue to do a lot of buybacks because now we are again below $80. This is not priced in by this market. They said they reduced the share count by 3%, but if you look at my table, you have a decline in shares of 1.39%. So why it is the case? Well, they issued some shares in a couple of quarters ago. Okay. Now that we have talked about all the adjustments, the company is also doing the work and adjusting some numbers. These are the adjusted numbers that the company is sharing with us. The adjusted net income and the adjusted earnings per share. So they are twisting some things here and there, and they come to the same conclusion. The company, if they are doing the same adjustments, they are seeing a net income growth of 15% and an earnings per share growth of, net earnings per share growth of 17%. So yeah, this one was pretty interesting. So now that we have accounted for the two adjustments, you now understand why this report is misleading. You now understand why nobody on Twitter wants to do the work, nobody on YouTube wants to do the work, but you have a few things happening at the same time. The core operations of the business are growing 16-17%. Okay. Do I go to my takeaways? Am I done with the report? Oh yeah, this is what I wanted to show you. The adjusted numbers from the company. They did a lot of adjustments and they say their non-GAAP net income, their adjusted profits, adjusting for everything, the net income grows by 15%. And if you do some buybacks, adjusting for everything, the earnings per share grows by 17%. And I believe this is why the company is very proud of this quarter. We are pleased, an excellent third quarter results report. During the call, the company was very proud of this report because if you adjust for all these accounting tricks, we are growing earnings per share at 17%. But Wall Street doesn't understand this. I believe Wall Street is expecting the company to disappoint, and you don't have a lot of growth. They only look at the short term. As always, Wall Street is short-term oriented. I mean, if you listen to the call, you will see that almost all the questions analysts had were about next year and the growth rate for the next quarters. What will be the growth rate for the product segment, for the service segment? Can you have a guidance? The management says, no guidance. And then the next analyst asks, can you have a guidance for next year? Can you share a guidance? And then the third analyst asks, can you share a guidance? Again, almost the same questions over and over again. This is the reason why retail investors have an advantage in this market, because you can look at the long term for this company. You are not, I know I'm not focused on the next quarterly results, right? I'm looking at the big picture, what is happening. And I consider all the adjustments to really see where the company is heading for the next 3 years, for the next 5 years, for example. And I see a lot of green flags for this company, okay? Also, the free cash flow is flat, strangely enough. You have a lot of capex. You have working capital, decrease in inventory, investment effect. And some notes. No, that's finished for the earnings report. So, a few key highlights I have for you, and that will be everything for this video. We are finished. Fortinet Q3 2025 highlights the key takeaways. This quarter confirms Fortinet is holding its own, executing well operationally, and expanding in higher growth areas like SASE and AI security. These two segments are growing. This is now 37% of the total billings, very high margins. Second point, you have a slight disappointment that is in the lack of acceleration and the guidance modestly under expected levels. They are conservative, they are guiding down by a little bit, and you don't have this huge reacceleration that all the cybersecurity providers are giving. So that's a yellow flag. This is why the stock is down, for good reasons. Everybody is accelerating and you are not accelerating. So this is a clear lack of acceleration. So this quarter is good, but not great. They explicitly expect service revenue acceleration in the second part of 2026. This is what I said at the beginning here. Now you have a revenue growth rate of 18% and you have this lagging effect. So the service revenues will go up, but not now. You have a lagging effect. So second part of 2026. So once the product starts renew into subscriptions, yes, they are bullish AI and they are already seeing growth acceleration because of it. This is what they're saying. We have too many opportunities. Well, I'm doubtful of this. Operating margins are at record high. GAAP is 32% operating margins, non-GAAP 37%. Strong cost control and efficiency. They highlighted growth in a high growth area, so SASE with the billings of 100% growth, but they are still small now. This is a very important thing to monitor in the future. Also, when it comes to geographies, I can show you something. I can show you the split between the 3 continents. Total Americas, Europe, and Asia. These are the 3 growth rates for these 3 regions. And as you can see for the blue line, Europe is trending up. The Europe segment is up 19%, so strong growth. The orange line, that's Asia, growing and accelerating, growing at 16% per year. But Americas are decelerating. If you look at only America, the growth rate is not so great. You have a growth rate of only 9%. So an analyst asked this question to the management team. What is happening with America? Do you have fewer customers? Are you less aggressive? And this is what the management has said. North America or US was very strong in the second quarter. There were some quarters where big deals come in and then other quarters not so much. They performed well, no share loss, thank you. If you wanted the red flag, maybe this is this one. This is a bad answer. I don't like this answer at all. This is the CFO said this. And this was a very good comment from an analyst. What are your growth rates for America? America is not growing so well. This is a laggard. Do you expect a recovery? Nothing is happening. They performed well. No share loss. Thank you. Next question. Maybe this is a red flag. A yellow flag, red flag, you judge. At the same time, the operating cash flows improved. And I told you the capex improved immensely. The capex increased immensely. The capex doubled. So this is something to monitor in the future, obviously. But this is also a yellow flag. So the business in the future will become less efficient. And I can show you what I mean. Because if you go to fiscal AI, you go to ratios, you go to capital efficiency, you go to, this one would be good, capex to operating cash flow. This is what you have. You can do it on a quarterly basis, last 12 months basis, anything is working. Come on. Okay, this is your capex to operating cash flow. How asset light are you? If this line is low, you are asset light. If this line is high, you are capital intensive. Now, this line is trending up and the company just announced investment in their own data centers. So this line will go up. You will have more capex in the future. And you will have less free cash flow in the future. Maybe something to monitor in the future. Okay? At the same time, you have a huge buyback, their biggest buyback ever, $1.8 billion. And I said, management literally tells you when their stock is cheap. Wonderful. I created these custom metrics. You will understand what is happening. I want to check the percentage of buyback to free cash flow. I want to check the percentage of buyback to operating cash flow and the revenue. Okay. Now you maybe don't understand this chart. Don't worry. I created these 3 custom metrics. The percentage of buyback to revenue in orange. So you compare the size of the buyback to the size of the revenue. How much of is your buyback? How large is your buyback? Same thing for the operating cash flow and for the free cash flow. You compare the amount to the quarterly free cash flow, etc., etc. You see 3 spikes here. One in 2022, one in December 2023, and one now. Management is not doing buybacks every quarter. They are timing their buybacks when the stock is cheap. And maybe you can play around with some numbers, with some valuations, or just put the stock price. This is your stock price. Here you do more buybacks, the stock was down. In purple here you have the stock price, okay? When the stock was down, they did more buybacks. And then the stock went up, no buybacks. They completely stopped. And then in 2023, the stock went down. Look at this, the stock price in purple went down and down. What did the management do? Major buybacks. I can only look at the red line. It will be easier to understand. So the stock drops, they do more buybacks. And then the stock goes up, goes up, goes up, goes up. No buybacks, no buybacks, no buybacks. And now the stock is going down and they do more buybacks. Literally, the management is timing the market. When the stock is cheap, they are very opportunistic and they are doing massive buybacks. Okay? Maybe this is all you need to know to buy Fortinet. The management is very confident. Largest buyback ever. And yeah, they are clearly telling you when they think the stock is cheap. You don't have a lot of companies that are doing this very well. Fortinet is doing this very well. So the management, as I said, the management literally tells you when their stock is cheap. Okay, this is not the first time you have this. I can put this in big size. 2017, 2020, during the first quarter, during the pandemic, they did massive buybacks. Here, here, here. Every time, if you had bought during these spikes, you would have been very lucky. A very lucky shareholder, a very happy shareholder. So now there is a spike. They are doing massive buybacks. Maybe this is a good time to buy. The management is literally investing in themselves. Let me continue. What do you watch for in the future for this company, for the future quarters? The SaaS growth, especially for the new segments, AI-relating segments, the migration, etc. The mix shift, more recurring revenue versus pure hardware, obviously. The guidance for free cash flow and capex about their new data center build-out project. And the margins. So far, the margins are nice. So far, the margins are trending up. Maybe in the future, you will have a margin compression because of this new investment in AI, okay? Maybe it is the case, maybe not. But you want to monitor this in the future. And you also want to monitor any commentary on upgrade cycle status. So the renewal, your subscription rate, how many months does it take for a new customer to grow from fully hardware to fully software, or both of them? What is this mix? What are the margins, etc. You want to monitor these 4 things. And here is the conclusion for this earnings report. In the short term, this is mixed. You have a decrease in guidance, you have a growth rate that is only 14%, you have plenty of adjustments to really understand the business model, and nobody on the call was talking about these 2 adjustments. So nobody's talking about the tax rate and nobody's talking about the reverse goodwill you had last year. So people don't understand this quarter. It beat the quarter, but guidance is slightly soft. It's an okay quarter. It's good, but not great. Now in the medium term, that's cautiously positive. You have success in the new leg of innovation. You have a clear path to reignite growth because of AI investments, and execution will matter. Next question for you. Do you trust the management team to be efficient in the future? Well, the answer depends on you, but you have a few things that will help you decide. For example, the management team wants the stock to go up, wants the margins to go up, wants the earnings per share to go up, because insiders own a big amount of the shares. Ken Xie owns 8% of the shares. The founder and the CEO has a large insider ownership. He owns 8% of the company, so he wants the stock to go up. Obviously, the interests are aligned. His brother, Michael, is the CTO, and he owns 17%. So the 2 brothers, they know everything. They own 15% of the company. So you have a clear alignment of interest for this company. Now, your judgment. You judge whether you believe the management team or not, if execution is important for you. The investor takeaway, this is a buy on dips scenario if you believe Fortinet can capture the next wave of AI, data center security. But if you are looking for spectacular near-term growth, this may be early. Now, this quarter was not so good, but you have a few signs that the growth will accelerate, that the margins will stay high, that the business will stay efficient, that the company wants to reinvest in themselves through buybacks. So now things are slowing down. What if growth is accelerating again? Because you will have more AI demand in the future. Well, during the call, the management team was talking about this new leg of innovation, the growth rate. They are pretty confident they can grow roughly 15% per year. You can buy a quality business that is expected to grow at 15% per year, that loves their shareholders because they are doing buybacks, very high margins. Now the management is very prudent for next year's guidance. You don't have the guidance at all. They didn't give us the guidance at all. Maybe they expect a deceleration. Maybe this is bad. This is also another reason why the stock is down on a pre-market level. You don't have visibility. People are worried. They are seeing a net income that is going down, and you don't have any visibility. But the bull thesis is still intact. The stock is down because Wall Street expected better, but the core operations are still very healthy. As I told you, the core operations are fine. The earnings per share are going up by 16-17% per year. And the business can reaccelerate. I'm buying. I will buy today. As I told you, I will partly sell Amazon and I will buy more Fortinet today. I was pretty convinced by this quarter because of all this work, all these adjustments. If you only look at the raw data, it can be scary. But I believe Fortinet is one of the best risk-adjusted stocks you can have right now in this market. So I'm buying more. Okay, well, I hope the analysis was not too complex. And I hope you could understand a little bit what is happening with Fortinet. Let me know if this was clear or not, because this is a very interesting stock right now. And after the price drop today, it's getting even better. I can show you the valuation. Well, it needs to be adjusted because the markets are not opened yet, right? But if you go to custom metrics, I have this metric, the EV to free cash flow or excluding SBC. I have created a custom metric for all businesses if you adjust for the SBC and the balance sheet. Here is what you have today. Now the stock is dropping 13%. So you can calculate what will be this new ratio today. Let me calculate it. You have 37. If you remove 13%, this ratio is at 32. For the past 10 years, this ratio, which I believe is the best metric to have a multiple on Fortinet, this valuation ratio, on average has been 36. The median has been 35. Now, today, when the market opens, we are at 32. So, if you compare this to the past, Fortinet is fairly valued or a little bit cheaper than the track record. So you have a quality company available at a fair price. If you don't want to adjust for the SBC, you can go to the forward valuation, EV to free cash flow. This is what you will have. Again, you have to adjust for today's stock price. And this new ratio today will be 24. So 24 was what we had here. We are back to levels we've seen a while ago. I believe Fortinet is one of the best risk-reward opportunities at the moment. And this is the reason I'm buying. And I believe if you buy right now, you can expect a very good performance. I mean, my goal is to make 25% per year, right? And I'm buying. So that tells you everything you need to know. I believe this is a golden opportunity to generate 20% per year. Time will tell if this video will age well or not. Well, if you like this new format, leave a like, you can comment. And let me know if you want to chat more about Fortinet. I don't know everything about the company, right? So if you have things to share to the audience, to the community, let me know in the comment section below, and I'll see you tomorrow. Bye-bye. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.